which we do have here. We have interest earned for $3,000. Interest earned. We're going to subtract any bank fees. We do have a bank fee here, or a maintenance fee of $100. And we're going to add or subtract any errors. So let's see. We've got an error here for check 111. So remember, this is the correct amount. This is the incorrect. Since we are incorrect, we're going to adjust our books to match the bank. So we should have subtracted $941 from our books, but we subtracted $914. So the difference between those two, $941 minus $914, is $27. And we will subtract that. Remember, this is a payment, a cash disbursement. We're paying someone $941, but we accidentally recorded it in our records as $914. So we've got to subtract even more. We've got to subtract $27. So we'll add that up. Our cash balance per the books, $84,736, plus the interest earned minus the bank fee and the error should give us $87,609. These numbers match, so we are good. Number 9 is asking us to do the journal entries for the bank memos. And remember, you only do journal entries for the book. So these interest earned, the bank fee, and the error, you only do the journal entry for. You don't do journal entries for any adjustments for the bank. You only do the entries for anything that you do to the books. So we'll start with the interest earned. For the interest earned, we're adding $3,000 cash. So we will debit cash for $3,000. We'll credit interest revenue because we're receiving interest for $3,000. There's our journal entry. Number 2, looking at the bank fee, we are subtracting $100. So that means we're going to credit cash for $100. And then the debit will be either bank fee expense or a miscellaneous expense. Either one's fine for $100. Entry 3, we're looking at this error for $27. We're subtracting $27 from our cash account, so we will credit cash for $27. And remember, the $27 is related to a cash payment of related to a cash payment. So we will debit accounts payable. There we go. So moving on to chapter 10, reporting and analyzing receivables. So it's saying on August 2018 we had $2,000 in sales, and we had 5% of sales to estimate bad debt, or they use 5% to estimate bad debt, blah, blah. And then a few weeks later, they collect $1970 and found out that $30 of the sale is uncollectible. Let's record the journal entry. So, starting off on August 1st, let's record the sale. We had $2,000. We sold $2,000. So we're going to debit accounts receivable for 2,000 and credit sales revenue for 2,000. There's our sale. Now, it's important to recognize that this is using percent of sales. We're not using percent of receivables. When we're using percent of sales, whenever we have a sale, we will take a percentage of that and calculate an estimate. So right after this sale, on the same day, August 1st, we're going to say 5% of these sales is going to be uncollectible. So if we multiply 2,000 times 5%, we'll get $100. We'll debit bad debt expense and credit allowance for doubtful accounts. Or you can write ADA. So this is our estimate. We're setting up the allowance for doubtful accounts. And remember, this is a contra asset, which takes away from this asset, accounts receivable. So as of now, what is our net receivables? Well, our gross, I'll write it here. Our gross accounts receivable is $2,000 from right here, this sale. We have allowance for doubtful accounts of $100. Since this is a contra account, it takes away from accounts receivable. So our net AR is $1,900 as of now. Now moving on, we have on August 20th, we collect $1,970. So we get $1,970 in cash, and we collect that from accounts receivables. And we also found out that we had $30 uncollectible. To record this write-off, we're going to debit allowance for doubtful accounts for $30, and we're going to credit accounts receivable. So we're taking away from ADA, and we're taking away from accounts receivable. That's percent of sales. Moving on, we've got number 11. At the start of the year, the allowance for doubtful accounts had a $5,000 credit balance. So I'll just right off the bat make an ADAT account. We've got a $5,000 credit balance, and accounts receivable has a debit balance of $70,000. During the year, the company made credit sales of $1,000. So what would that journal entry look like? Well, if we had, $100,000 in sales, we would debit accounts receivable by $100,000 and credit sales revenue by $100,000. So our accounts receivable T account would be debited $100,000. We had a write-off of $8,000. Whenever we have a write-off, we debit ADA for $8,000 and we credit accounts receivable for $8,000. So that means we're debiting ADA for $8,000 and we're crediting accounts receivable by $8,000. Of all the receivables, $90,000 has been collected by the end of the year. What's that journal entry look like? Whenever we have a collection, we receive cash, so we'll debit cash for $90,000, and we'll take that out of accounts receivable for $90,000. We're crediting accounts receivable here, so we'll credit accounts receivable by $90,000. A customer called during the year and paid $1,000 of a receivable that was originally written off. So how do we reverse a write-off? Well, here's our write-off journal entry. We debited ADA, credited accounts receivable. To reverse that, we just do the opposite. We're going to debit accounts receivable and credit ADA for the $1,000. But that's not where we'll end. We just reversed the write-off, and now they paid us. So we had a collection of $1,000. So here's our collection of cash for $1,000, and we'll take that out of accounts receivable. So these two journal entries, we debited accounts receivable by $1,000, we credited ADA by $1,000, and we credited accounts receivable by $1,000. Now it's asking us, what is the balance in accounts receivable at the end of the year? So we'll calculate that. We began with 70, added 100, added 1,000, subtract 8,000, subtract 90, and subtract 1. So our ending balance, and if you didn't follow that, our debits minus our credits gives us a debit balance of $72,000, which is B. Number 12, we have $1 million of accounts receivable. So we'll make the T account right away. $1 million in accounts receivable. If it is estimated that 5% of accounts receivable will be uncollectible, what is the net realizable value of those receivables? So recognize that this is percent of receivables because we're saying 5% of accounts receivable. So our accounts receivable, our gross accounts receivable is $1 million. What's our ADA? Well, our ADA ending balance is 5% of accounts receivable. So we'll take 5% of 1 million to get $50,000 is ADA, and remember it's a contra asset, so it takes away from accounts receivable, and we're left with $950,000 as our net realizable value. Number 13, with the following information, perform an estimation of bad debts. So when we have an aging schedule like this, it's percent of receivables, because again, we're taking a percent of our accounts receivable. These are accounts receivable amounts. So we have $20,000 that have been outstanding for 1 to 30 days, 12,000 30 to 60 days, and 4,000 that have been outstanding for more than 2 months. And we're saying 1% is uncollectible from this section, 20% is uncollectible from here, and 40 from here. So we'll just multiply across. 20 times 1% is 2,000. 12,000 times 2% is 2,400, and 4,000 times 40% is 1,600. We add those up to get 6,000. And now, remember that this number that you calculate is the ending ADA balance. That's where most of you will screw up. This is, whenever we're having percent of receivables, the number that we calculate using these percentages is the ending ADA balance. So this is an ending ADA balance of 6,000. If you scooch back to number 12, taking 5% of $1 million, we got $50,000. That's our ending ADA balance whenever we're using percent of receivables. So there's our ending ADA balance. It's asking total estimated uncollectible. That's 6,000. It might also ask you what's the net accounts receivable. And we'll do just like what we did before. We have a gross accounts receivable of, here's all of our accounts receivable as of now, 20 plus 12 plus 4 is 36,000. Our ADA ending balance is 6,000, so we have a net accounts receivable of $30,000. What's our bad debt expense? You might be tempted to say 6,000, but that's incorrect. We're going to assume that allowance for doubtful accounts has a $300 credit balance. So our ADA T account has a $300 credit balance at the beginning. We want it to have a $6,000 ending balance. So how do we do that? Well, we're going to have to credit it by some amount, and that amount is going to be $5,700. That number is our journal entry, so the journal entry would look like bad debt expense for $5,700, ADA credit for $5,700. There's our bad debt expense, $5,700. Let's use the same numbers, except that ADA has a $300 debit balance. Well, our total uncollectible is still 6,000 because that's still our ending ADA. Our net AR is still 30,000, but our bad debt expense is going to be different. So we have an ADAT account with a $300 debit balance, but we want it to have a $6,000 credit balance. How do we do that? Well, we're going to have to credit it by some amount. That amount is $6,300. So again, the journal entry would look like bad debt expense for $6,300, credit ADA by $6,300. So there's our bad debt expense, $6,300. Moving on to number 14, we've got a note receivable that we switched from an account receivable. The note is $10,000 with 6% interest, and it's due on April 30th, 2018. So there's 3 dates that are important with these note receivable questions. The first date is obviously when the note is created, which is, kind of screwed that up, it's going to be 10/1/17, October 1st, 2017. We set up a note receivable for $10,000. Remember, note receivable is an asset. It's similar to accounts receivable. The difference is that a note receivable charges interest, while accounts receivable does not. So we set up a note receivable for a client or a customer because they could not pay their accounts receivable. So we'll decrease their account receivable and switch it to a note receivable. There's our first date. We set it up on October 2017. The second date is the end of the year to record or to make our adjusting entry. Now remember, from exam 1, adjusting entries have a revenue or an expense and do not include cash. So in this case, we're not going to have cash, but are we going to have a revenue or an expense? We're going to have a revenue because we're charging them interest, 6% interest. Revenues are credited. We're charging 6% interest for the $10,000 note, but we only charged interest for all of October, November, and December, 3 of the 12 months. So to calculate this, we take the $10,000 note times 6% times 3 of the 12 months. So that equals 150 as our interest revenue. Our debit is going to be interest receivable. Because again, there's no cash involved. They're not paying us cash. But they owe us interest, so it's an interest receivable. There's our adjusting entry. And finally, we'll go on to the final date, which is April 30th, 2018. This is when the note is due and when they have to pay us. So we're obviously going to credit or debit cash because they're paying us cash. We're also going to get rid of this note receivable because they pay it off and they pay off the full note receivable. I'm going to skip cash's amounts because we don't know how much money they're paying us quite yet. So they're paying us $10,000 for the note receivable. They're also paying us this $150 for the interest from last year. And I screwed this up. There should be another box down here. We're also charging them interest for this year. So, how many months has this note been outstanding? Well, January, February, March, and all of April. So that's again, or not again, that's